Hello and welcome everyone. We will just be starting in 2-3 minutes so that students join. Okay, so let's start now. Okay, so the first thing which you all should do is for today we have a new file of handouts from which we will be doing questions. It's attached in the handout portion which has been sent to you. So kindly download this file so that I can start. Okay. Hope you have downloaded the file because from this file we will be doing the question. I'm sorry, due to illness, I have to, when I'm coughing, I have to pause and mute. So apologies for this. Now, in today's class, what we are going to do is that we will be doing our and try to do our coverage of two topics, right? In the previous three classes, what we have done is that we have studied the portion of investment appraisal. We have studied the portion of weighted average cost of capital. Okay. And then we have studied the portion in the last class of sources of finance. Okay. Now in today's class, what my plans are that we will be doing two portions. Try to do two portions. The first portion is the portion of risk management, which I will try to do in the first portion of the class. And the second portion is basically business valuations. Okay, so these are the two portions which we plan to cover in today's class. And as you all know that when we talk about the portion of risk management and business valuation, there can be no CRQ. CRQ means constructive response question of section C worth 20 marks is not possible either from risk management or from business valuation. Okay, you can only face MCQs or OTQs, that means section A questions or section B questions from each of them. Okay, so in today's class, what my plans are, it entirely depends on whether we have sufficient time or not. My plans are that we'll be doing two OTQs, objective type questions, section B questions from risk management, and similarly two OTQs, objective type questions from business valuations. Okay, so that you get some know-how regarding these two topics. Okay. Now talking about risk management. Okay, we all know that in the portion of risk management, one is expected to deal or hedge currency risk, and a smaller portion one is expected to deal or hedge interest rate risk. In the portion of risk management, one is expected to deal with hedging of currency risk, and one is expected to deal with the hedging of interest rate risk. Okay, so again, not even for 5 minutes have passed, and there are questions that what about working capital management? I think this thing has been told multiple times in the webinar that you cannot expect to complete each and every area of the syllabus in just 4 days. 4 days means only 10, 11, 12 hours. Okay, so this expectation is wrong. You are talking about working capital management. We may not be able to complete these 4 questions because I have to discuss them. But what is the solution? The solution was told to all of you that if any topic is left, we can provide you extra support via videos of that. So please, a person should remain realistic. Okay, in 10 hours, obviously it is not possible to cover each and every year either, or we do just a flurry and don't understand anything and just for the sake of completion. So have patience. If anything is left, definitely you should be realistic, then we will provide you extra support. Okay. Okay, so in interest rate risk management and currency risk management, you are asked to hedge or deal with currency or interest rate risk. Now, remember, just a quick recap. Currency risk. What was currency risk? That when a company wants to payment, the rates go up. Risk or when it is receiving money, the rates go down. This was called as currency risk. That, for example, a company is in Pakistan and plans to pay $5,000 in 3 months. There is always a risk that dollar rate may go up. This is called currency risk. Or company is in Pakistan and it will receive $1,000 in 2 months. There is always a risk that rates may go down. This risk is called currency risk, that when company has to pay, the rates go up. When company has to receive, the rates go down. Then there were three types of currency risk, or there are three types of currency risk. One is called translation risk. One is called transaction risk, and one is called economic risk. Currency risk is of three types. One is called translation risk, one is called transaction risk, one is called economic risk. Now, what is the difference between all these three types of risks? When you talk about translation risk, translation risk occur when financial statements are translated from one currency to another. Okay, so translation risk occurs when financial statements are translated from one currency to another. Like you are translating, for example, financial statements from dollar to PKR. You are translating the financial statements from GBP to dollars. So whenever financial statements are translated, the risk we face is called translation risk. Transaction risk. Transaction risk is the risk which occurs on a transaction. Buy or sell. Like a company is buying something. Obviously, when you buy something, there is a risk that rates go up. When you're planning to sell something, there is a risk that rates go down. So whichever risk is on buying or selling, typically buying means imports and selling means export. So any risk on buying, selling, that is imports and exports, is called transaction risk. Okay, and economic risk is risk of loss on both buy sell transaction. It is also a transaction risk, but it is considered a heavy form of transaction risk. Okay, it is considered a heavy form of transaction risk, that if company is buying something and selling something, it is facing loss on both transactions. This is called economic risk. So there are three types of currency risk: translation risk, which occurs when financial statements are translated from one currency to another; transaction risk, risk on any buy sell transaction; and economic risk, that risk of loss on both buy and sell transaction. Okay. Now, if a person wants to hedge or minimize currency risk, if a person wants to hedge or minimize currency risk, the commonly used techniques in the exam are forward exchange contracts and money market hedging. There are other techniques as well, but the most commonly used techniques in the exams are forward exchange contracts and money market hedging. These are the two most commonly used techniques. Forward exchange contract, we fix the forward rate, and money market hedging, some heavy calculations which we will be shortly discussing. But in order to hedge or minimize currency risk, there are two commonly used techniques: forward exchange contracts and money market hedging. But before moving to the question of these two techniques, in order to solve any question of currency risk management, you must have an idea about currency codes. Before moving to any of these techniques, you must have an idea about currency codes. Because without having a knowledge of codes, it is practically impossible to solve any currency risk. Now, as far as quotes are concerned, there are two types of one quote and one quote. As far as quotes are concerned, there are two types of currency quotes. One is called indirect quote, one is called direct quote. You must memorize three things with respect to each quote. You must memorize three things with respect to each quote in order to be able to solve the question properly. Indirect quote sign is foreign currency numerator, local currency denominator. Whenever you see something like this, that foreign currency is coming in numerator and the company's home currency or local currency is denominator, that's indirect quote. In indirect quote, to convert from one currency to another, we always divide. And in indirect quote, out of the two rates, the lower rate is always the buying rate and the higher rate is always the selling rate. Okay, you must memorize these rules. Whereas in direct quote, we see that local currency comes in numerator, foreign currency comes in denominator. So whenever you are seeing in the question that the company's home currency is coming in numerator and foreign currency in denominator, that's a direct quote. Whenever you find a direct quote somewhere, you always multiply to convert. In indirect quote, we divide to convert, but in direct quote, we multiply to convert. Okay. And in direct quote, lower rate is the selling rate and the higher rate is the buying rate. Okay. So these quote rules are not made by class tutors or the Kaplan text. This is what happens in real currency markets, that whenever you see currency signs like this, like foreign currency comes in numerator and local currency in denominator, it's an indirect quote. You divide to convert, lower buying, higher selling. And direct quote is local numerator, foreign denominator, you multiply to convert, lower rate is selling, higher rate is selling. I want you to please copy these quotes so that we can move towards the questions. Ahmed, you have problem in currency swap, but the very good news for you is that currency swap only comes in theory MCQs. There is no calculation in the syllabus, so you don't need to worry regarding that. Okay. So the thing is that I just gave you a go through that if you are talking about currency risk, so you must know what currency risk is. So currency risk basically means when a person or a company wants to pay something, the rates are expected to go up. Like many people are facing this, that they plan to pay ACCA fees in pounds. So when they have to pay the fees next month or next week, they are always afraid that the pound rates go up. This is currency risk, that when you are paying, the rates go up. When you are expecting to receive, the rates go down. This is currency risk. Now, how to deal, manage, or minimize currency risk? Before that, I told you that there are three types of currency risk. Translation risk, which occurs when financial statements are translated or converted from one currency to another. Transactional risk on imports, exports, buying, selling, and economic risk when you get loss on both the transactions. The method of dealing with these risks, most commonly used methods are forward exchange contract and money market hedging. Okay, and forward exchange contract is basically where we fix this rate for the future. We will just be doing that. Okay, and another way of dealing it is money market hedging. Okay, before starting the questions, you must have knowledge, detailed knowledge about quotes. So there are two types of quotes, operational quotes. One is called indirect quote, one is called direct quote. You must memorize the rules of all of them. Indirect quote is where foreign currency comes in numerator, local, and denominator. You divide to convert. Lower rate is buying, higher rate is selling. And direct quote is where local currency comes in numerator, foreign currency in denominator. You multiply to convert, and the lower rate is selling, higher rate is buying. Now, taking this knowledge of currencies, let's start our question practice. So the first question, we will be doing the questions from the handouts file, which has been shared with all of you. There are many questions in this handout file, but I'm just telling you that which questions we are starting with. The first question in this handout is Daswin Company. We will do it later. We'll start from second question. This question is Marigold Company. This is from risk management. We will be firstly doing this question. Okay. Okay. The question states, Marigold Company is based in a country which uses dollar as its home currency. Okay, so Marigold is based in a country which uses dollar as its home currency. You must know which is the home currency, which is not, because that helps you to decide in determining the quotes. Because if foreign currency is in numerator, local is in denominator, you say indirect quote. If local comes in numerator, foreign in denominator, you say it's a direct quote. So Marigold is based in a country which uses dollar as its home currency. Marigold has a wholly owned subsidiary based in a country which uses M shillings, MS as its currency. So Marigold has a subsidiary. It's based in a country which uses shillings as its currency. The subsidiary's financial statements are prepared in shillings. Subsidiary is obviously in another country. Its financial statements are prepared in shillings. Due to economic uncertainty in both countries, an exchange loss of 100,000 is expected to occur after consolidating the results of subsidiary into Marigold's group accounts. So due to economic uncertainty, an exchange loss of 100,000 will occur after consolidating results of subsidiary into Marigold group accounts. Obviously, when you have a subsidiary, you make group accounts. So an exchange loss of 100,000 will occur if you consolidate the results of subsidiary into group accounts. Marigold is expecting a receipt of shilling 300,000 from subsidiary in 3 months. So a receipt is expected in 3 months of shilling 300,000, which it wishes to protect against exchange rate movement. Following information is available. Exchange rates are shilling per dollar. Now pay attention to this. This is very important. Dollar was the home currency, local currency, home currency, dollar, and dollar is coming in denominator. It's MS per dollar. So dollar was the home currency, local currency is denominator. From here we get to know it's an indirect quote. When there will be indirect quote, we will divide to convert. And the two rates are given: spot rate, today's rate, and 3-month forward rate. Spot rate, today's rate, and 3-month forward rate. Two rates are given. Since it's an indirect quote, the lower rates will be the buying rates and the higher rates will be the selling rates. Okay. You will be provided the currency information as well, else you cannot solve the question. So the only thing you have to capture is direct quote or indirect quote. Once you capture the quote, if it's an indirect quote, you divide. If it's a direct quote, you multiply. Okay, so the important thing is to capture quotes. Since my home currency was dollar and dollar is coming in denominator, so when local currency is in denominator, it's an indirect quote. You divide to convert, and your lower rate is basically the buying rate and higher rate is basically the selling rate. Then you are given the deposit and borrowing rate. So deposit and borrowing rate of shilling is given. Deposit and borrowing rate of shilling is given. 3.6%, 4%. This is the annual rates of deposit and borrowing in shillings, and deposit and borrowing rate of dollar is given. This is the information, and this is going to be the total information of a currency risk management question. This is the total information, and this is going to be the total information of currency risk question. That company is in a country which uses dollar. Dollar is the home currency, and Marigold has a wholly owned subsidiary based in a country which uses shillings. Okay, so it uses shillings. Subsidiaries' financial statements are prepared in shillings. Due to economic uncertainty, exchange loss of 100,000 is expected to occur. So you're expecting a loss of 100,000. Okay, after consolidation. And Marigold is expecting a receipt of 300,000 shillings from subsidiary in 3 months. And it wishes to protect against exchange rate movements. Exchange rates are given. Since dollar was coming in denominator, which was the home currency, it's indirect quote. You divide low rate buying, high rate selling. And then you are given the borrowing and deposit rates in both currencies. Okay. Jawad and Amir. I think the question is provided in the handout as well. So no worries, the screen was paused. You have the question there as well. So anyways, the question is now on the screen as well. Just quickly go through the question again. The question states Marigold is based in a country which uses dollar as its home currency. So you see this dollar as its home currency. This will always be given. And dollar is the home currency. Okay, so Marigold is based in a country which uses dollar as its home currency. Marigold has a wholly owned subsidiary based in a country which uses shilling as its currency. So it has a subsidiary that uses shillings. So Marigold is a country which uses dollar as its home currency, and it has a subsidiary which uses shillings. The subsidiary's financial statements are prepared in shillings. Due to economic uncertainty in both countries, an exchange loss of 100,000 is expected to occur after consolidating the results of subsidiary into Marigold's group accounts. So whenever there is a subsidiary, there is always consolidation into group accounts. So when you consolidate into group accounts, an exchange loss of 100,000 will occur. Marigold is expecting a receipt of 300,000 shillings from subsidiary in 3 months. So important thing is 3 months, and you're expecting a receipt of 300,000, which it wishes to protect. Now exchange rates are given shillings per dollar. So you see it's given shillings per dollar. Exchange rates are given. So exchange rates are shillings per dollar. So if you are given an exchange rate of shillings per dollar, you have already been told that shillings per dollar, so dollar comes in denominator. When your home currency, local currency dollar is coming in denominator, here you will know it's an indirect quote. You will divide to convert, and the two rates are given: spot today's rate and 3-month forward rate. The lower rates will be the buying rates and the higher rates will be the selling rates. And then the borrowing and deposit rates are given. Borrowing rates are given in shillings and deposit rates are also given in shillings. And the dollar rates of borrowing and shillings are also given, but important thing, this is annual rates. Always remember, this is the only information which a currency risk question can provide you. That's it. So the summary was it uses dollar home currency. It has a subsidiary which uses shillings. When consolidation was done, there was an exchange loss of $100,000 and receipt of 300,000 shillings is coming. Exchange rate will always be provided. The currency will always be provided. Okay, that since shillings per dollar, dollar in denominator, it's an indirect quote, divide, lower buying, higher selling, and borrowing deposit rates are given. Let's start the requirements now. Okay. What type of exchange rate risk would Marigold experience with 100,000 loss in the consolidated financial statements? What type of exchange rate risk would Marigold experience with 100,000 loss in its consolidated financial statement? Remember, there was 100,000 loss in the consolidated statements. So what type of exchange rate risk would Marigold experience? Economic risk, translation risk, transaction risk, and political risk. So what type of exchange rate risk would Marigold face? Exchange rate risk is never D. So exchange rate risk is either economic, either translation, either transaction. Okay, I never taught you that exchange rate risk is political risk as well. Exchange rate risk are of three types: translation, transaction, economic. So what type of exchange rate risk were experienced with 100,000 loss in the financial statements? Now please pay attention. If this 100,000 loss is coming just due to translation of financial statements, this will be translation. Okay. If it's coming due to buying or selling, import or export, it's transaction. And if it's coming on both, it's economic. Okay. So this 100,000 risk was not coming because you bought something, because you sold something. Remember, you were in USA dollars and your subsidiary was financial statements preparing in shillings. So when subsidiaries financial statements were consolidated, translated into group accounts, then this risk came. So this risk is supposed to be a translation risk. Okay. But company is expecting a receipt of 300,000 shillings. Company is expecting a receipt of 300,000 shillings in 3 months. If question had asked you that company is expecting a receipt of 300,000 shillings in 3 months, what is this risk? Is this 300,000 receipt coming because of financial statements conversion? No, it's not translation. When does receipt comes? Receipt comes when you sell something. Receipt inflow comes when you sell something. So this is on selling. It's a transaction risk. Okay. And for example, it was a payment of 300,000. When does payment come? When you buy something. It's on buying. It's transaction risk. However, if it says we are facing risk on receipt as well as payment, then it's economic risk. Okay. But this 100,000 was lost just because of financial statements conversion. It is supposed to be a translation risk. There is a question from Sana, that 100,000 is not translation risk. I have corrected the option B, that 100,000 is the translation risk. So why you are asking that 100,000 is not translation risk? Yes, Assam, you're right. So Sana, I don't know whether you are attentive in the class or not. The question is asking about 100,000 and that's why I take translation risk. Just to explain further, that had the question asked about 300,000, I would have put transaction risk. So please stay attentive in the class. The question is asking about 100,000, that's why we take on option B. Okay. Question 2. If Marigold uses the forward market to hedge the receipt, what amount it will be received? Now it is asking what amount will be received if company uses forward market. Forward market means forward exchange contract. If it uses the forward markets to hedge, what amount it will be received? Forward market means forward exchange contract. Okay. So Vanya, that's I think what I told in the lecture, that if it's on both things, then it's economic. So if Marigold uses the forward market to hedge the MS50, what amount would be received? So it is asking if Marigold uses the forward market. Forward market means forward exchange contract. What amount would be received? So if it uses forward market to hedge the receipt, how much receipt is coming? It's shilling 300,000. how much receipt is coming, it's shilling 300,000. For forward exchange contract, you always use forward rates, right? For forward exchange contract, you always use forward rates. Spot rate are today's rate, but for forward market, you use forward rates. Okay. So there are two forward rates. It's shilling 300,000. How much will be involved to forward exchange contract? Will you multiply or divide? It's an indirect quote, so you will divide. And since it's a receipt case, when receipt comes, we always do the contract to sell. We will use selling rate. However, if it's payment case that we are paying, for payment, we always do the contract to buy, because in payment, we have to buy a currency, and in receipt, we have to sell currency. When you have to pay someone, like you have to pay ACCA, you have to buy pounds. But if someone is giving you pounds, obviously you will go and sell. So always remember the rule: in payments we use buying rate, and in receipts we use selling rate. So this is a receipt, multiply or divide. Since it's receipt, we will use the selling rate. The selling rate is 1.1125. Only use the forward rates. Okay. No need to perform these workings on spreadsheet, obviously, because it's MCQs, MTQs only. 300,000 divided by 1.1125, it's 269,663. So we have done two MCQs. The first MCQ is what exchange rate risk would it face on 100,000 loss of financial statement? That's obviously a translation risk. And second, it's forward exchange contract. So we use the forward exchange contract hedging. The third requirement is match the appropriate value to the relevant target in order to reflect what amount Marigold would borrow and deposit if it uses the money market to hedge. So match the appropriate value to the relevant target in order to reflect what amount Marigold would borrow and deposit if it uses money market. So we have to match the value to the relevant target in order to reflect what amount Marigold would borrow and deposit if it uses money market hedging. In short, the question is asking money market hedging. In short, the question is asking money market hedging. Okay. Now, when you talk about money market hedging, always remember money market hedging has some systematic steps. Always remember money market hedging has some systematic steps. It's a receipt case, right? It's a receipt case. Money market hedging will have some systematic steps. So it's a receipt case, right? We are receiving shillings $300,000. We are receiving shillings 300,000. Okay, so money market hedging has some systematic steps. It's a receipt case or a payment case? It's a receipt case. Shillings 300,000 is being received in 3 months. Shilling 300,000 will be received in 3 months. Okay. Money marketing states that when you are receiving something, first go to foreign bank and borrow. Money market hedging under receipt states that whenever you are receiving something, first go to foreign bank and borrow. whatever you are receiving, don't borrow that. You're receiving 300,000 shillings, right? Don't borrow that. Borrow some less amount. How much less amount? X. So that when interest is charged of 3 months, it becomes exactly equal to shillings 300,000. Money market hedging under receipt says that when you're receiving shillings 300,000, don't borrow from foreign bank 300,000 receipts, because borrowing 300,000 will create interest and your liability will increase. So borrow less amount, X, so that when this borrowing creates interest for 3 months, the amount becomes 300,000 shillings. So if you are borrowing X, so that when it gets interest of 3 months charge, it becomes 300,000 shillings. What is the borrowing rate on shillings? You are borrowing shillings, right? You are borrowing shillings. So when you are borrowing shillings, you will use the borrowing rate of shillings. It's 4% for annual. It's 4% for annual. So if it's 4% for annual, for 3 months, it's going to be 1%. If 4% is for whole year, for 3 months, it's going to be 1%. So X into 101% becomes shillings 300,000. X the amount we should borrow. Divide 300,000 by 101%. 297,029. Borrow this. Okay. Then when you borrow this amount, the next step of money market hedging in receipt says go to money exchange and sell this currency. Go to money exchange and sell this currency. Now, if you will go to money exchange and sell this currency, how much shillings? 297,029. He will give you dollars. Okay. If you will go to money changer and sell this currency, he will give you dollars. How much dollars? Convert them into dollars. Multiply, divide. You are selling, right? You are selling. So divided by the selling rate. What is the spot selling rate? 1.125. Okay. Forward rates are only used in forward exchange contract. Remember, in money market hedging, all transactions are taking place now. So we use the spot rate, 1.125. So this gives you how much dollars? $264,026. Okay. And the third step says, when you get dollars, go to local bank and deposit these dollars. Go to local bank and deposit these dollars. Now what will happen? You borrowed 300,000 was a receipt coming in 3 months. You borrowed less amount X, so that this borrowing created interest of 3 months equal to 300,000. You borrowed less. Now 297,029 was what? After charging interest of 3 months, it will become 300,000. Then go to money changer and sell this currency. So obviously, when you in home currency is the US dollar, when you will go and sell this currency, you will get dollars. Selling, so selling rate 1.125, you got dollars. Go to local bank and deposit dollars. Now, after 3 months, when this $297,029 shillings liability will become 300,000. Obviously, after 3 months, the foreign bank loan 297,029 shillings will become 300,000 shillings after charging interest. Your receipt of 300,000 will come from abroad. Your receipt from 300,000 will come from abroad. Clear loan, clear foreign bank loan. Now, what did you deposit in local bank? 264,026. Take that out. How much interest you are getting you to depositing in local bank? In depositing per annum. So for 3 months, it's going to be 1 point. You deposited dollars. So now you won't use the borrowing rate. You are borrowing shillings, so use the borrowing rate of shillings. You're depositing dollars, use the deposit rate of dollars, 1.5%. 3960, you will get interest. So the final amount which you are going to get is 267,986. This is how much dollars you will get from money market hedging. Now, what was the requirement? Requirement was match the appropriate value to the relevant targets in order to reflect what amount Marigold will borrow and deposit. So how much amount Marigold is borrowing? You see, Marigold is borrowing in shillings, 297,029 or 297,030. This is borrowing in shillings. How much Marigold will borrow and deposit? It's not asking the final answer of money market hedge. It's just asking how much it will borrow and deposit. So you know it borrowed 297,029, and how much it deposited? 264,026. So this is going to be your answer. Okay, we have done 3 MCQs from this. Any questions you can ask, or you can copy the stuff, and then I will discuss the remaining 2 requirements. So Vanya, why are you multiplying with 105%? Where is 105% coming from? Yes, Hamza, hedging may result in loss as well. Amir, it didn't ask the final answer. It asked how much you will deposit. So you are just depositing this. So Vanya, when it's 1.5%, you should multiply with 101.5%. Why are you multiplying with 105%? You are not applying the calculator correctly. 1% means 101%. Why are you doing 105%? Then examiner will ask the final answer. What is the final answer from money market edge? Jawad, 1.5% is given in the question. 6% is the annual deposit rate. So for 3 months, it's 1.5%. Amir, I have answered this yesterday as well, that we cannot predict anything, what areas the question will come from, how much theory percentage, how much calculation. This cannot be predicted. It's better you go through the past papers, you will get an idea regarding this. I'm sorry, we cannot comment on this. Yes, then this is the past paper question. I don't think there is a question here, Maham, that whether we should round up or not. We have the option. It's very clear that our answer is 297029 and it's 297030, so we should opt it. So no need to worry regarding that. Okay, one student is asking to repeat the first and the last step. So first step is whatever receipt is coming, money market, I think states whatever receipt is coming, borrow from foreign bank a lesser amount, X. How much lesser? So that when interest is charged, it becomes equal to exact amount. So you are borrowing, you are receiving 300,000 shillings, borrow less amount X, so that when interest is charged, it becomes equal to 300,000. So if you see shillings borrowing interest is 4%. So for 3 months, it's 1%. X into 101%, it's 300,000. So you should borrow 297029. Okay. Secondly, go to money changer and sell. So when you will sell, you will use spot rate. Forward rates are only in forward exchange contracts. Okay, you will sell. So selling is selling rate 1.125. You get dollars, and then deposit those dollars. Okay, so when you deposit, you get the interest on deposit rate. Okay. So Maham, 101.75% means you are using 1.75%. 1.75% is nowhere in the question. Where is 1.75% coming from? Okay, now these two theoretical questions are left, and as far as the long questions are concerned, long questions theoretical requirements are a bit easier, because if even the student doesn't know the complete setup, what he can just do is that he can explain in his own words some points and get marks. But in theoretical MCQs, if you have studied it properly, the theory has been read via text, that's what we advise our regular students, then you will be able to address this, because this usually comes from the Kaplan study text. Therefore, I advise everyone here, please go through the risk management chapters in the Kaplan text if you want to get through these requirements carefully. Marigold is now considering the use of an option to hedge the currency risk. Obviously, there is a product called option in which you get a right, not an obligation. Either you take it or leave it. If you do a forward exchange contract, you have to fulfill it. But if you are basically doing an option you can simply take a right, not an obligation, you can leave it. So Marigold is now considering the use of an option. Bank has offered an option with an exercise price of shillings 1.125 per dollar. Which two of the following statements concerning the options are true? The option will be more expensive to set up. An imperfect hedge will result as the option will be for standard amount. If the dollar was to strengthen against the shillings, Marigold is likely to be worse off by using the option. Using an option hedge will mean Marigold is obligated to exercise the option. Okay. Some points are very easy. Which two of the following statements are true? Okay. Using an option hedge will mean Marigold is obligated to exercise option. Option is just a right. It's never an obligation. That's why it's called an option. So using an option hedge will mean that Marigold is obligated. Wrong. Option is never an obligation. Okay. Then an imperfect hedge will result. Option does not create an imperfect hedge. It creates a perfect, or a normal hedge does not create an imperfect hedge. That's what clearly mentioned in the Kaplan text. So this is also wrong. The correct answers are A and C. Why I'm explaining. The option will be more expensive to set up. This is written in the Kaplan text that options are more expensive than forward contracts or money market hedging. Why? Because options require payment of some premium, because of which options are expensive. So if you have just learned the features of options, you can answer this. That I used reverse working, that I removed D and B to reach to the correct statements, but you can just kick off with the correct statements. That it's clearly written in the Kaplan that option is more expensive than others because it involves a premium. So A is correct. Okay. And if the dollar was to strengthen, Marigold is likely to be worse off by using the option compared to forward market or money market. Now let's suppose you are using you are receiving shillings 300,000 in 3 months, and you do an options contract. When you're receiving 300,000 shillings and you enter into an options contract, that okay, this is the rate 1.125, and I will receive 300,000 shillings. It's an indirect quote divide, and the options rate is 1.125 per shilling. So 1.125. You do a contract at this rate, you will receive 266,666 dollars. If dollar is further strengthened, dollar becomes more strong, then obviously Marigold is likely to be worse off. Likely to be worse off means it will face loss. Obviously, if dollar improves, dollar strengthens, because of this contract, we have locked that we will receive this amount. If dollar strengthens, we will be in further loss. That's what is saying, that if dollar was to strengthen, Marigold is likely to face loss or worse off. So this statement also seems correct. The correct answer of this would be A and C. Either use the correct statements or remove the wrong statements. Let me do MCQ number 5 and then we will take the questions. Marigold is unsure whether to use a forward contract or a money market hedge. It's unsure whether to use a forward exchange contract or money market, and it's comparing the advantages and disadvantages of two. Which of the following advantages and statements is true? Now, there are 4 options. In the previous requirement, it clearly mentioned which 2. So in the previous one, you have to tick 2. But here, it's saying which of the following statements is true. No 2 answers, just 1. This is also straight coming from the Kaplan text. You have maybe you have read the advantages and disadvantages of forward exchange money market. It's coming straight from that. Marigold is unsure whether to use forward market or money market. Which of the following statements? The forward contract has the advantage of being tailored precisely to Marigold requirement, but the money market hedge will be standardized instrument. The forward contract will result in Marigold receiving dollar equivalent of receipts in 3 months, whereas money market hedge will provide Marigold with dollar receipts today. The forward contract will result in effective rate of exchange being fixed, whereas money market hedge will allow Marigold to benefit from favorable movement. Marigold will be obligated to fulfill the forward contract in 3 months, whereas money market hedge could be traded on exchange to another party before settling. If you read all 4, the most clear-cut answer that's clearly mentioned in Kaplan, it's answer B. Read it carefully. The forward contract will result in Marigold receiving the dollar equivalent of receipts in 3 months, whereas money market hedge will provide Marigold with dollar receipts today. That's what the basic difference between forward exchange contract and money market hedge is. In forward exchange contract, you fix a forward rate, 3-month forward rate. That means you have committed that we will do at this rate dealing in 3 months. Whereas in money market hedging, remember I just saw the question as well. In money market hedging, we use the spot rates, right? In money market hedging, we use spot rates. Spot means today's rates. So in money market hedging, whatever is happening, it's happening today. So that's what the basic difference between forward exchange and money market hedge is. That in forward exchange contract, whatever is happening is in 3 months, and in money market hedging using spot rates today, B is the answer. Okay, so 4 and 5 are in front of your screen. Now I can take questions with respect to 4 as well as 5. So Faizan, part B says that imperfect hedge will result. So option does not create an imperfect hedge, it creates a perfect hedge. That's what written in the Kaplan text. And as far as D is concerned, Faizan, using an option hedge will mean Marigold is obligated. Option, there is no obligation. It's just a right. So there is no obligation. That's why B and D is wrong. Part C, Mr. M. Zarshan. You see, if you read the question number 4 statement, that options have a price of 1.125. I'm receiving 300,000 shillings. If I use the option, I will get 2660666 through this rate. But if dollar further gets strengthened, then obviously I will get a loss. Because I fixed the rate 266,666. If dollar strengthened, I would have received more money. Option A, Sana, is just the advantage of disadvantage of option, that it's more expensive than others. Okay, Mr. Satul, we have shared everything on the WhatsApp group. You can do that group. Maham, apart from option, everything is an option. Yes, options are expensive. Okay. Now, obviously, this question took a lot of time because after every requirement, there were some series of questions from the students. Now, I want you all that we will do one more MCQ of risk management, but you need to attempt it on your own quickly. I will solve its theoretical parts. Okay, that. Okay, Virginia, all handouts are shared in the handout tab. You can download from this GoToWebinar tab, and this thing I have told multiple times at the start of the class as well. That handouts are attached in this. You can download them, and you can also join our WhatsApp group because everything will be shared there. I'm just sharing my WhatsApp number as well. You can drop me a text on WhatsApp after the class. I can admit you in the group. Okay. Now, in this second question, that is Noon Company. Okay, that's in your handouts as well. Okay. So what my target is that you read this question and do part A and part C on your own, because that has just been discussed, part A and part C, and remaining parts I will solve it for you. Let's start. It states that Noon Company, a company based in Centerland. Please pay attention. Noon Company is a company based in Centerland whose home currency is Centerland colon CC. So you got to know that home currency is Centerland colon CC, has been regularly buying components from and selling finished products to businesses in Flyland, where the currency is the Flyland franc. So Noon Company is based in Centerland, home currency is this CC. It has been buying components and selling products to businesses in Flyland, currency is FF. One particular payment of 3 million FF has to be made by Noon Company to a supplier in Flyland in 3 months. Now this is a payment. Previous question was of receipts. This is a payment of 300,000 in 3 months. Following information is available. 2 spot rates are given and 3-month forward rates are given. Now pay attention. Spot rate is 6.170-6.210 FF to the CC. Yani ke FF over CC. Spot rate is 6.170-6.210 FF to CC. Flyland francs to CC. 3-month forward rate is 6.321-6.362 Flyland franc to the CC. That means FF to CC. Now, home currency is CC. Home currency is CC. It's coming in denominator. Again, it's an indirect quote. Again, that means you will divide to convert, and the two rates. The lower rate written is the buying rate and higher rate written is the selling rate. If someone says it's US dollars, to GB, so it's Flyland franc to CC, that means FF over CC. Borrowing rate, deposit rates of Flyland franc is given, Centerland colon is given, it's per annum, right? What is the cost in CC of a forward market? What is the cost in CC of a forward market hedge? Now, how much payment we are making? One payment of 3 million in 3 months. So it's 3 million payment, 3 million FF in 3 months. What is the cost of a forward market hedge? Forward market hedge means forward exchange contracts. It's 3 million payment, multiply, divide. You're paying. For payment, you need to have a buying contract. For payment, you need to have a buying contract. So for payment, you need to have a buying contract, you need to buy. In forward exchange contract, we need forward rate. What is the forward buying rate? 6.321. Lower rate is buying rate. $474,608 CC. Okay, now we will first do part C. What is the cost in CC of a money market hedge? Now this case is relating to 3 million payment in 3 months. This case is relating to 3 million payment in 3 months. Okay, it's asking for money market hedge. Now in money market hedge, when it's payment, it states deposit money in foreign bank. Okay, if it was receipt, remember, borrow from foreign bank. It's payment, deposit in foreign bank. How much you have to pay? 3 million FF. Don't deposit full amount. Don't deposit full amount. Deposit some less amount, X, so that when the deposit earns interest, it becomes equals to okay. In receipt case, it states borrow from foreign bank, but in payment money market hedging states deposit in foreign bank. Calculation is same, but just borrowing deposit is different. If you are paying 3 million in 3 months, deposit in foreign bank, whatever you are paying, 3 million, not the full amount, less amount X, so that when deposit earns interest for 3 months, you get 3 million. So depositing FF, how much interest it's giving? 13.5% per annum. So for 3 months, it's going to be 3.375%. So 103.375%. 13.5% is per annum. So for 3 months, it's 3.375%. X should be deposited, earning interest of 103.375 gives 3 million FF. So the amount deposited should be 2902055. Always borrow deposit less, because when interest is charged, it becomes equal to the exact amount in 3 months. Okay, so 2902055 FF should be deposited, so that when interest is earned for 3 months, it becomes 3 million. Now when you deposit amount, you need to have that amount. So the next step states go to money changer and buy this amount. Go to money changer and buy this amount. Remember, in receipts, go to money changer and sell the amount. Here, go to money changer and buy this amount. You need to buy 2902055 FF. Multiply, divide. You are buying, so use the buying rate but spot rate, because in money market hedging, spot rate is used. 6.170. So how much dollars will be needed? 2902055. 470,349 CC will be needed. And the third step says, where do we get this 470,349 CC? Because money changer, you are buying FF, you need to give him CC. How to get this CC form? Borrow this amount from local bank. So it's just the case that in receipts it was borrow from foreign bank, sell to money changer and deposit in local bank. Now it's deposit in foreign bank, go to money changer and buy this amount and borrow from local bank. When you borrow 470,349 CC from local bank, you have to pay interest on borrowing. So how much interest you have to pay on borrowing CC? Now you are borrowing CC, take the borrowing rate, 8.1% per annum. You are borrowing for 3 months, right? So 2.025% for 3 months. You have to pay interest of 2.025%. The interest in CC would be 9524, and the final answer will become 479,873. So you have done one question of receipts and one question of payments. Copy. If you have any questions, please ask. Okay, so it's just that if you're facing a question of receipts, it's borrow from foreign bank, sell and deposit. Whereas in payments, it's deposit, buy and borrow. So in the previous question, you can see that we first borrowed from the foreign bank, sold it to the money changer, and then deposited in the local bank. But here you first need to deposit from in foreign bank, go to money changer and buy, and then borrow from local bank. Okay, you can copy. If you have any questions, you can ask. Remaining 3 MCQs we will do after Okay, so we are resuming now. Requirement B, D, and E, the three requirements are left. So requirement B, which of the following relationships attempt to explain the difference between forward and spot rates of exchange between two currencies and relative rates of interest in the countries offered? So which of the following relationship explains the difference between forward and spot rates and relative interest rates? Two theories you might have studied. One is called purchasing power parity theory, and one is called interest rate parity theory. Okay, two theories are in F9 syllabus. One is called purchasing power parity theory, one is called interest rate parity theory. Now, what is the difference? Both almost have same formulas, okay, but purchasing power parity theory explains relationship between forward rates and inflation rates, and interest rate parity theory explains relationship between forward rates and interest rates. Okay, purchasing power parity theory explains relationship between forward rates and this inflation rates, and interest rate parity theory explains relationship between forward rates and interest rates. So these are the two theories which explain the relationship between forward rates and inflation rates, purchasing power parity, and forward rates and interest rates, interest rate parity. Okay, that's why the formula of purchasing power parity is forward rate S1 is equals to spot rate into 1 plus inflation rate of country over inflation rate of other country. Okay, purchasing power parity formula is S1 forward rate is equals to S0 spot rate into 1 plus inflation rate of one country over 1 plus inflation rate of other country. And the formula of interest rate parity is also the same. S1 forward rate is equals to S0 spot rate into 1 plus interest rate of one country over interest rate of other country. Okay, let me show you this as well. In the examination where you are given the formula sheet, you see the formula of purchasing power parity and interest rate parity is given. Use any variables S1, F1, F0, whatever. S1 and F0, they are forward rates. If you can see, S1 and S0, they are forward rates. This and this, they are forward rates. These are spot rates. Purchasing power parity states into 1 plus HC over 1 plus HB. HC and HB are inflation rate of one country and inflation rate of second country. Whereas in interest rate parity, F naught forward rate is spot rate into 1 plus IC over IB. IC and IB are interest rate of country 1 and interest rate country 2. So the formula of purchasing power parity and interest rate parity is almost the same. Purchasing power parity theory tells you the relationship between forward rates and inflation rates. See, in the formula it is using inflation rates, whereas in interest rate parity it's using interest rates. Now as far as your question is concerned, requirement B. Requirement B is which of the following. Requirement B is which of the following relationship attempts to explain the difference between forward and spot rates of exchange between two currencies and the relative rates of interest in countries. So what is the relationship which explains the difference between forward and spot rates of exchange and relative interest rates? So the relationship that explains the difference between forward rates and interest rates, that's interest rate parity. That's not purchasing power parity. That explains the relationship between forward rates and inflation rates. But the thing that explains the relationship between forward rates and interest rates, that's interest rate parity. Then D. Indicate by clicking in the relevant boxes whether the following statements on the characteristics of interest rate futures are true or false. So in the Kaplan text, the characteristics of futures are clearly mentioned. Either currency futures or interest rate futures, the characteristics are mentioned. Amounts and periods are standardized. You don't get futures, either currency futures or interest rate futures, on your own wish. They are standardized. They are legally binding. Yes, every contract is legally binding apart from options. I have told you this, that options don't have an obligation. Everyone else has an obligation binding. They can be bought and sold on secondary market. Secondary market means you can sell this to someone else. Yes, future can be sold to someone else. Forward contract cannot be sold to someone else. Futures contract can be sold to someone else. They can be used to both hedge as well as speculate. Yes, futures can be used to hedge as well. And people who like betting and speculation, they can use that as well. So remember, in this topic, the currency risk management and the business valuation, reading the text is very important, because you see, whatever theoretical questions I'm seeing, they are coming straight from the Kaplan text. Okay, it's 4 features are clearly written in the Kaplan text, that it's a standardized contract. You cannot use a tailor-made contract in futures. It's standardized. It's legally binding. Option is not legally binding. Others are legally binding. You can buy and sell to others, and they can be used in hedging as well. Last requirement. See, this is a very mark scoring requirement as well. If inflation is currently running at 3.8% per annum in Centerland, what is the inflation rate in Flyland? If inflation is 3.8% per annum in Centerland, what is the inflation rate in Flyland? Now, inflation rates are present in which formula? I just told you, purchasing power parity formula. Inflation rates are present in which formula? Purchasing power parity formula. So if it states that inflation rate is 3% in Centerland, what is the inflation rate in Flyland? So the inflation rate is present in purchasing power parity formula, which is S1 is equals to S0 into 1 plus HC or IC. Country 1 inflation rate, country 2 inflation rate. Okay. Now, are you given spot rate? Yes, S0 is the spot rate, right? So are you given spot rate? Yes, you are given spot rate. 6.170. S1 is forward rate. Are you given forward rate? Yes, 3-month forward rate is given 6.32. You are given spot rate as not 6.170. You are given forward rate as well 6.321, 3-month forward rate. Inflation rate of two countries need to be placed. Now, since this spot rate 6.170, it's FF over CC. Remember, it's 6.170, 6.210 FF over CC. So since FF flyland is above, we will put the inflation rate of flyland above, and CC is in denominator, so we will put inflation rate of CC in denominator. Okay, so inflation rate of flyland needs to be found out. Okay, inflation rate of flyland needs to be found out. So inflation rate of flyland is X, and inflation is 3.8% per annum in Centerland. So what we are doing here is that we have the forward rate, okay, 6.321, and we have the spot rate. Since spot rate is FF over CC, it's a question that which inflation rate will come in numerator, which in denominator. Since FF is in numerator in the currency rate, the rate of FF will come in the numerator. That's to be found X, and in denominator, the Centerland loan. So the Centerland inflation rate is 3.8% per annum. Okay, since the interest rate is 3.8% per annum, you have used the rate of 3-month, right? So you need to put a 3-month rate, that's 0.95%. Since it's 3.8% per annum, but you have put a 3-month rate, so rates have to be for 3 months. If you put per annum rate, you must put the forward rate of also for 1 year, but that's not available. Since you have put 3-month forward rate, that means you need to put a 3-month rate, and this will help you to find X. Okay, let me solve it for X. X is coming as 3.4%, but this 3.4% is not per annum. It's 3-month rate, right? The question is asking annual inflation rate. So 3.4% is for 3 months. So for per annum, 3.4 is for 3 months. For per annum, you need to multiply it by 4. It's 13.6%. And question is saying round off to the nearest percent, so 14% will be the answer. Okay, this ends our all questions of currency risk. If you have any questions, you can ask please and copy the solution. Yes, Arslan, you can do that. It's a payment question. That's why the rates we used are buying rates. Had it been a receipt question, Amir, we would have used the selling rates. Because Abbas, you are taking 6.321 as the 3-month forward rate. So since you are taking 3-month forward rate, you need to have interest and inflation rates for 3 months. So Assam 3.8% was per annum. We need to put 3 months. So 3 months is 0.95%. 3.8% is for per annum. So for 1 year, you need to, per month, you need to divide it by 12, and for 3 months, multiply by 3. Aman, it's just cross multiplication, mathematics. Apply the calculator on calculative values and do it. Yes, full marks will be lost. Bassam, wrong. Receipt means you are receiving money. When you receive money from someone, you sell it to money changer. And when you are paying someone, you buy from money changer. Okay, now we will do one question of business valuation. That's in your handout called Coral Company. So please open this question of Coral Company. Okay, now as you all know that in business valuation, you may be asked to find values of the company, and you may be asked to find the market values of debt. So for that, again, this is not a part of long question, only MTQ. And those who are saying to repeat part A, repeat part B, actually, I want to do one question of business valuation. So you will have the recording of this webinar. So please, you can get back to it later. Apologies for that. Okay. So let's start. The question states, the finance director of Coral Company has been asked to provide values for the company's equity and loans. So finance director of Coral Company has been asked to provide values for the company equity and loan notes. Obviously equity means shares and value means loan notes means the company's debentures. Okay, so the finance director has been asked to provide values for the company's equity and loan notes. Coral is a listed company and the following long-term finance. Ordinary shares are 7.8 million, 7% convertible no notes 8 million, total capital structure comes to 15.8 million. So finance director has been asked to provide values for companies equity and loan notes. Coral is a listed company, has the following long-term finance. Ordinary shares are 7.8 million and 7% convertible loan notes 8 million. Ordinary shares have a nominal value of 0.25 per share. This has been discussed multiple times in the classes that if ordinary shares in total are 7.8 million, the capital, and shares have a par value of 0.25, you can divide it to get number of ordinary shares, which is 31.2 million. Okay, ordinary shares have a par value of 0.25 and 7.8 million is the capital. You can divide to get number of ordinary shares 31.2 million, and are currently trading on an ex-dividend basis at 7.1 per share. Currently they are trading at 7.1 per share. So currently they are trading at 7.1 per share. Economic recovery has been forecast, and so share prices are expected to grow by 8% per year for the foreseeable future. Share price will go by 8% per year. Loan notes are redeemable after 6 years at their nominal value of 100 and can be converted after 6 years into 10 shares of Coral per loan. So loan notes are redeemable after 6 years, nominal value of 100, and converted on 6 years into 10 shares per 100 loan note. Loan notes are traded on the capital market. Before tax cost of debt, KD, 5%, and tax rate is 20%. Okay, this is the information that finance director of Coral has been asked to provide values for the company's equity and loan notes. Coral is a listed company, has following long-term finance: ordinary shares 7.8 million, convertible loan notes 8 million, 7.8 million, 8 million, ordinary shares of a par value of 0.25. I got number of shares 31.2 million, and they're trading at 7.1 per share. They will grow at 8% per year. And loan notes are redeemable after 6 years at 100, and they can be converted also into 10 shares. And the cost of debt is 5%, tax at 20%. What is the equity market value of Coral Company? What is the equity market value in millions? Equity market value is simply number of ordinary shares into current share price. Equity market value is simply number of ordinary shares into current share price. So what are the number of ordinary shares? 31.2 million. And what is the current share price? 7.1. 7.1 is the current share price, 31.2 is the number of ordinary shares. So equity market value comes to the formula of equity market value, value of shares is number of ordinary shares into current share price. You have the number of ordinary shares, you have the current share price, that's it. Okay, now the second requirement is Assuming conversion, what is the market value of each loan note? Assuming conversion, what is the market value of each loan note? Assuming conversion, what is the market value of each loan note? Now, if you look at the question carefully, it states here, the loan notes are redeemable after 6 years at par value of 100, or can be converted after 6 years into 10 shares of Coral Pearl loan note. Loan notes are redeemable after 6 years. Okay, they're redeemable at their par value of 100, and they can be converted after 6 years into 10 shares per loan. So loan notes are redeemable after 6 years at nominal value of 100. They can be converted after 6 years into 10 shares. Loan notes are traded on the capital market. Okay. Assuming conversion, what is the market value of loan note? This is a very mark scoring part, so please pay attention. What is the definition of market value of loan note? Please pay attention. Market value of loan note is defined as the present value of outflows of loan note. Outflows of loan note are interest and redemption or conversion, calculated on a before tax basis using cost of debt as discount factor. If anyone doesn't know this thing, I suggest them to please learn this. This is a very important 2 marks area. It always comes in the exam. Always the question will ask, one MCQ will ask you to calculate the market value of loan note. It's the present value of 2 outflows of a loan note. A loan note only has 2 outflows, interest and redemption or conversion, calculated on a before tax basis using KD, cost of debt as discount factor. So since this question is asking you market value of loan note, what is the market value of loan note? So market value of loan note is basically the present value of 2 outflows, interest and redemption conversion discounted at KD. Now this loan note is, because you are solving this assuming conversion, you are solving this assuming conversion. Okay, so it can be converted after 6 years and it pays 7% interest. It's converting after 6 years. It's converting after 6 years and it pays 7% interest. So 1 to 5, 6. 2 headings are made because it is being converted after 6 years. So 2 headings, 1 to 5 and 6. Okay. 2 outflows of this loan note, interest and redemption or conversion, but we are solving this assuming it's conversion. Do you think since it's a 7% loan note, so interest will be 7%? 7% of what? Always par. The par value of loan note is 100. So for 6 years, the interest will be 7. Interest is paid each year, right? So 7% interest of par value 100. So interest is 7% of par, 7% of 100, 7. Conversion. Look at the conversion. Converted after 6 years into 10 shares per loan note. So if you're converting after 6 years into 10 shares, each share is of 7.1? No. 7.1 is the today's current share price. It's growing at 8% per year. So if today's share price is 7.1 and it's growing at 8% per year, since these 10 shares will be converted after 6 years, share price after 6 years will be 8% increase per year. So after 6 years, it will increase by 8% each year. 11.26 after 6 years, because 7.1 is now. This is being converted into 10 shares after 6 years. So since 7.1 is the current share price, it's growing by 8% per year. So after 6 years, it's going to be 8%, 8%, 8% increasing, 11.26. So this will produce 112.66. So two outflows will be interest. You can write negative, positive, your choice, 7. And if converted, another outflow company has to give 10 shares at 11.26%, not 7.1. Two outflows. Net them all. You will get net cash flows. 7, 119.66. These are the two outflows, interest and redemption. Now to convert it into present value of outflows, net cash flows need to be multiplied by discount factor, which should be K. What is the cost of debt in the question? Cost of 5%, 1 to 5 and 6. So a 5% year 6, it's 0.746, 5% year 6. Seven four 0.7, it's 0.6 and 5%. Net cash flows into discount factor gives you present values. 7 into 4.329 and 119.66 into 0.746. And if you add them all, you get total present value, which is 30.3 plus 89.2. 119.5. This is the present value of all outflows. 119.5. So this is the market value of all. Because you see, I have fulfilled the definition. This present value, this is the present value of two outflows. What I have done, I have calculated the present value of two outflows, interest and conversion. That's what the definition is, present value of two outflows. Please copy this. OS, you need to calculate for one bond. One bond is 7% of par. What you are doing is total. Ozafa, look at the definition. It's calculated on a before tax basis. Satolife, it's 7.1 today and it's increasing at 8% per year. So after 6 years, when it will be converted, share price will increase from 7.1 by 8% per year 6 times. It's 7% of par value 100, Karanjit. So 7% of par value 100 is 7. Amir, this is not a point of confusion whether the question is from WAC topic or valuation topic. Obviously, market value of loan note you have to calculate. So even in WAC, the market value of loan note definition is the same. Even if the business valuation, the definition is the same. So it doesn't matter. Okay. So we have got the equity market value, number of shares into current share price. We have also got the market value of loan note. Which of the following statements about the equity market value of Coral Company are true? Which of the following statements are true? The equity market value will change frequently due to capital market forces. So Amir, that's a problem in your concept, because that is done when you have to find KD, cost of debt. In market value of bond, we never do this. In cost of debt, we do that thing which you are saying, and in market value, we only do this. So this is a conceptual error from your end. So which of the following statements about equity market value of Coral are true? The equity market value will change frequently due to market forces. If the capital market is semi-strong from efficient, the equity market value will not be affected by the release of public of insider information. Over time, equity market value will follow a random walk. Which of the following statements are true? Now, the conceptual statement among all these three is just two. That is from the concepts. The others are general. You can answer them. Okay. So the equity market value will change frequently due to market forces. What was the formula of equity market value? The formula of equity market value was number of ordinary shares into current share price. Remember, number of ordinary shares were 31.2 million, and you multiplied it with current share price, that was 7.1, you get 221.52 million. It's saying that equity market value will change due to capital market forces. Now, do you agree that due to capital market forces, the share price changes? Yes, due to capital market forces, market conditions, the share price changes. So obviously, when share price will change, the equity market value will also change. When capital market forces will play their role, market pressures, environment, market conditions, the share price will also change, and that will change equity market value. So this statement seems true, that equity market value changes due to market forces because market forces change share price. If the capital market is semi-strong form efficient, the equity market value will not be affected by release of insider. This statement is a conceptual statement and this is wrong. Why? You were taught from Kaplan study text, and those who haven't studied this thing, they should listen. If market is weak form efficient, if market is weak form efficient, it can get affected by public news or information as well as insider information. If market is semi-strong form, it gets affected by insider information. And if market is strong form, it doesn't get affected by anything. Okay, this is what was taught to you in 3 levels of efficiency, that if markets are weak form efficient, they get affected by 2 things: public information and inside information. If markets are semi-strong form efficient, they get affected by inside information, and if they're strong form, they don't get affected by anything. So look at statement 2 now. If the capital market is semi-strong form, equity market value will not be affected by inside information. That's wrong. If markets are semi-strong form, equity market value will be affected by inside information, because semi-strong form means you will get affected by insider. Just saying it will not be affected by insider, that's wrong. And third, over time, equity market value will follow random walk. Now, what does random walk means? Random walk means no logic. Random walk means just a random on its own, no logic. So equity market values do follow a random walk, because when you just look at the equity market value is number of ordinary shares into current share price. Equity market value is number of ordinary shares into current share price. Current share price randomly change in the market. Sometimes they get changed due to results, due to news, due to manipulation, but sometimes they just follow a random walk. They randomly change without any reason falling, without any reason rising. So this statement is also true. So the correct statements are 1 and 3. So statement 1 was correct, that market value changes due to market forces because share price changes. They follow a random walk as well. And equity market value is affected by inside information in semi-strong form. It's saying it does not affect it, so it's wrong. Any questions, please ask. Without any reason. You see this? Means random walk. Random walk means so if you Maham, random walk means without any logic. Okay, so if you look at the stock market prices, sometimes they go up and down without any reason. That is called random walk. So when it goes up and down without any reason, the share price changes and the equity market value changes. So equity market value does change due to random walk. Noman, ACCA does not publish the section B questions of all attempts. For one or two attempts, you may get it from the website. Now, indicate by clicking in the relevant boxes whether the following are assumptions that are made by dividend growth model. Dividend growth model formula is this. P naught is equals to D1 upon K minus G. And in weighted average cost of capital, the formula of K is D1 over P naught plus G. It's just rearranging, right? If you need to find P naught share price, it's D1 upon K minus G. And if you need to find KE, it's D1 over P naught plus G. So identify by clicking in the relevant boxes whether the following are assumptions that are made by DVM. Again, if you read the text of business valuation, DVM assumptions are clearly mentioned. Dividends show constant growth or zero growth. Yes, the growth rate remains constant or there is no growth. Growth rate can never be negative. This is written in DVM disadvantages and assumptions that dividends show constant or zero growth. Investors make rational decisions. This is also written that they make rational decisions, don't make irrational decisions. And dividend growth rate is less than cost of equity. That's not written, but that's something you can get from the formula. Growth rate is less than K. See, the growth rate G has to be less than K. Otherwise, the answer of denominator will come negative. The growth rate G has to be less than K. K is 10%. It has to be less than that, 5%. Because if that is the case, then only answer will come positive, else the answer will become negative. So growth rate has to be less than cost of equity. This is also an assumption. All three are answers. Investors make rational decisions. That's written. Either show a constant growth or zero growth. Growth rate is less than K. Last MCQ. Why might valuations be needed for equity and loan notes? Why might valuations of equity and loan notes be necessary? In short, it is asking why you must value your shares and your loan notes. Why must you value your shares or loan notes? The company is planning to go to the market for additional finance. Yes, if you want to raise additional finance, people ask you what is your value. So due to this, it might be necessary to find the value, because if you want additional finance, securities need to be valued for tax purpose. A big wrong. Do you think to calculate taxation, you need to have value of your company? No, for taxation, you only need profits. For taxation, you only need profits. You don't need to have company's value. Like you go to taxation department, how much is our tax? They say, okay, what is your value? Taxation is never on value. It's on profits. So you don't need to value your equity and loan notes for taxation purpose. This is a big wrong. Two is wrong. The company has received a takeover bid from a rival company. Obviously, if someone asks you to acquire or wants to acquire you, for that purpose, you need to have a value. So 1 and 3 seem correct. Any questions with respect to last two MCQs, please ask. Rajiv, I'm sending you my number. Please drop a WhatsApp on this number after the class, and I will add you in WhatsApp group. Recordings are shared there. Okay, now, since this question is over, now we have last 5 minutes. I have a good news and a bad news for you in this last 3-4 minutes. Okay. The bad news is that this was the last day of the webinar. It was a 4-day webinar. So on day 1, we Noman, I just saw your question, and you are saying statement 1 is right. That's what I've written. That statement 1 is correct. So the bad news is that this was the last day of the webinar. On the first day, we covered business investment appraisal, and on the second day, we covered weighted average cost of capital. Then we covered sources of finance. Then in today's session, we covered risk management, and finally we had plans to do 2 questions of business valuation, but we were only able to solve 1 question. Okay, so obviously as far as the aspect is concerned, we are covering 5 sections. Zan is asking why working capital management is not covered. Okay, obviously, if anyone, I said this in day 1 as well, anyone coming with the expectation that you have 4 sessions of 3 hours, total 12 hours, when every session there is 20 minutes of break, you remove them. So you have 10.5 hours, and you expect that in 10.5 hours you will be able to cover each and every area of the syllabus. Impossible. Expectation is wrong. Okay, this is a wrong expectation that in 10.5 hours you can cover an area which I teach personally when I teach to my regular students in 120 hours. Okay, so I think this is an unrealistic expectation. Okay, in order to cover all areas, what we should do is we should not answer any of your questions, because this also wastes time. Okay, we should just quickly solve questions as if I am just reading and solving questions. No need to explain anything, no need to do anything, and just quickly solve the answers and go. Obviously this is not my style of teaching. Okay, so whenever I conduct these webinars, obviously it happens every time. Either I conduct it for, sometimes I conduct it for advanced financial management, sometimes I conduct it for audit and assurance, sometimes I conduct it for PM performance management. This time I'm converting for financial management. Every time the whole area is not covered. But this isn't a technological era. This is a technological world. You have contact with me directly. If you have any questions with respect to these webinars, and you have any problem in further areas, like for example, one student may message here that why didn't we solve this question from the kit? Obviously we cannot solve. This is not possible that every student's requirement can be catered, but we have our contacts, and I have my regular course as well. So if you have any problems in any area, you can always drop me a message. I can provide you video support, I can provide you tutoring support for 1 or 2 topic, obviously without any charge. So this will help you to cover it. Obviously we cannot, because we cannot cover everything in these 10-11 hours. Okay, secondly, I requested the ACCA to give me 1 more session like this. Okay, and they said that all the slots are occupied, because obviously this is not the only webinar, the other papers webinars are also being conducted. So I requested them, and they honored my request. So they gave me 1 additional day on 29th May. They gave me one additional day on 29th May. Okay, we will cover some more questions on that 29th May. The timings and stuff has been added in your schedule. Okay, so webinar was originally for 4 days, but this one day they gave me to my request so that I can support you more. Okay, and still if on that day as well, after that day as well, you still find some confusing areas, you can always drop me a message. Again, some students are messaging WhatsApp link can't be copied, copy isn't an option in the chat. Daily I have told this thing 4 or 5 times daily, and even my condition is not good and still you are forcing me again to repeat the stuff. Even in today's class, this has been told 3 times that I have shared my personal WhatsApp number with everyone, and I've told them that please drop me a message, I will add you manually. Okay, I hope this helps, because even the whole 4 days are passed and still repeating the 10-20 times a thing, and still some students are just stuck on that WhatsApp group thing. Okay, so anyways, we are just ending the class now. Okay, and I think I have shared 2 recordings of first day and second day. Okay, and the third recording is also ready, so I will just be sharing it after the class. And those 3 days, the 4th day recording, today's recording will be shared tomorrow. We will now meet on 29th. Okay, and I will cover some more areas in this particular 29th May recording. Thank you very much for attending. Before leaving the class, please do give a general comprehensive feedback of this 4 days, whether it's helpful or not, because this always helps us to improve further for the next webinars. Okay, take care, thank you, and please don't go without sharing the feedback.